In this video, we'll be discussing a mean reversion trading example using the VWAP indicator as we trade the ES index for our futures trading accounts. This example took place on Tuesday, October 11th. When using our VWAP indicator, we anchor it to the opening of the overnight session that preceded our regular trading hours. And from there, we start to gather some information. Here we see that the majority of the inventory was being collected below VWAP. We can mark some significant supports and resistances for our usage moving forward and try to get an idea of how to make a play based on what we're seeing. Remember, VWAP is our mean and the most agreed upon price based on the amount of volume that was traded at that price. You might also remember that prices at standard deviations above or below VWAP can be seen as undervalued or overvalued. Below being undervalued and above being overvalued. Here at 9:30, the market opens to a large sell-off. I look below our support and ultimately holding. And we begin to start challenging a cycle back over our VWAP indicator. At this point, we could see that we're mostly ranging inside of our supports and resistances. When the opening candles of an S&P 500 session are incapable of going below the overnight lows or above the overnight highs, we could begin to look for plays that take advantage of the ranging price action. And we will be looking to see if a significant rejection of a standard deviation line away from VWAP could provide us with a low risk entry to join large position traders in their liquidation of inventory and revert back to VWAP by the end of the day. Let's see how it plays out. As our candles begin to move higher, we see rejections of both our support and our third standard deviation away from VWAP. As we get our first red candle close, as a sign that may lead us to believe that we're beginning to rotate back to VWAP, we can consider our options for entering a position. This is often called a look above and fail of second standard deviation. As we know from our units on standard deviations away from VWAP, prices that are too far away from VWAP and are at the many standard deviations above VWAP can be considered to be overvalued. When the market agrees that the price is currently overvalued, it will try to make higher highs above the standard deviations and also fail. This is a good sign for the trader that the price may want to revert back to the mean, where the mean is our VWAP line. In this case, it would be a short position with our price target back to VWAP and our stop loss just beyond our previous candle to ensure that our read is still valid. As the candles play out, our former resistance is becoming support. We are working to sell off back to our VWAP reversion. Here, after enough inventory has been collected, we see that there is finally a liquidation event wherein we had joined the large size traders that got ready to distribute inventory at 3 standard deviations away from VWAP. With our price target being VWAP, we more than safely hit this position for a successful trade.